Focus ahead of a big week of bank earnings. Vito Sperduto of RBC Capital Markets saying M&A activity is delayed, not derailed. Writing the backlog of M&A opportunities continues to build. Deals will happen. They're just not happening as quickly as many had expected. Vito, it's good to see you. Good morning.
Thank you for having me.
The difference between those two words, delayed and derailed. What inspires confidence that this is just a delay and not a derailment?
Well, I think the fundamental conditions have continued to be very solid. I think the corporates are sitting flush with cash, more so than they have historically. I think for clients, for instance, we're open to lend to clients to support their transactions, much like we were earlier in the year. I think people have gotten comfortable with the current environment. They are operating in an environment of constant uncertainty. And so when you talk about whether it's tariffs or other policy coming out of D.C., you have to plan for multiple scenarios. And so what we're finding with our clients is that they're preparing for transactions. There's a fair amount that they'd like to do. They're continuing their plans. It's just a question of when do you make the decision to do it. And so it's delayed to the right. It's not being taken off the table. And so I think there's a fair amount of activity when the window does open.
A lot of people said it was a wait-and-see economy, and then Delta Airlines happened. And Ed Bastian came out and said that things are stable, businesses have clarity, they're investing again. Have we broken out of that wait-and-see economy?
I think some have. I think we're seeing it certainly. I take a look very closely, for example, at the CEO Confidence Index out of the Conference Board. So the median there is 50 on a scale of 0 to 100 in terms of the inflection point. In the first quarter, which was taken in February, CEOs were at a 60, meaning that they were confident in the forward outlook. They felt positive about it. The survey that was taken in mid-May dropped to 34. It's the biggest quarterly drop that you've seen. So what happened between February and May? Liberation Day. So that tariff and policy uncertainty, concerns about geopolitical instability, and then also an uncertain regulatory environment in some cases has driven them to not make decisions. And so when they looked at that, a very high number of them felt that we were in a worse position versus 6 months ago, back in May. But what we are seeing is that, look, I think you look to Trump 1.0 versus this, it took a full year of the first administration for people to get their arms around what it meant. I think it's happening quicker now, and I think the better companies are prepared, and they're going to enact policy.
The pipeline is rich. The pipeline is there. Look, I think that one reason why a lot of people are looking at this is because we are going to get the earnings from JP Morgan and Citi tomorrow, and Wells Fargo, and then from Morgan Stanley and Goldman Sachs on Wednesday. And people are wondering how much of a boom this is going to be to them, considering that heading into this year, it was supposed to be the year of M&A. Didn't happen. How much has that been derailed?
Well, I think you're seeing, if you look at M&A volumes this year, announced volumes, it's actually up versus last year. But a lot of those transactions in the first quarter were things that were already on the books about to happen. And so you have U.S. M&A announced volumes are up 16% this year. Globally, it's up 26%. But it's really larger deals, billion-dollar plus, are driving that. And the smaller deals, sub $1 billion, are actually slightly down in value. So what's happened is a lot of it's just been, like we talked about, pushed to the right. People should not be surprised by this. Like I said just now, this is what happened back in 2017 during the first administration. But what we are seeing is that where we sit today versus the beginning of the year is that there has been a tightening of the bid-ask spread. I think parties that are prepared and feel confident are out there doing transactions. I think sellers that need capital and need to, for instance, if you're a private equity firm and you need to return capital to your LPs, you're looking at various alternatives. It might not be a traditional sale, but maybe you look at a continuation vehicle. Maybe you're looking at some structured equity. Maybe you're looking at a minority sale or taking a loan on your net asset value. And you're finding ways to return capital because that's the lifeblood of what they need to do.
I wonder how much the scenario for how people are financing these purchases has changed with yields where they are. Have you seen people less willing, or companies, not people, companies less willing to incur debt to make those purchases and wanting to do it all stock or cash or whatever, just simply because of the fees?
I think if you go back 2 years ago, a year ago certainly, I think people had not accepted this new level yet. I think they've accepted it now. So they understand rates higher for longer. I think if you look at where the calls are, for instance, our rate desk just pushed out their call last week that instead of a first cut happening in September, it's now going to be December. Just because it's too short of a window to August 1st or to the September meeting to really see any statistics that will allow the Fed to cut. And so as a result, I think companies are saying, I'm going to be in this environment longer. I need to make the right decisions for my business. It's too soon to just focus on 26 and beyond, but I think a lot of folks are looking at their more longer term plans. And as a result, you're seeing them make decisions that are strategic. I always like to say, good strategic transactions will happen, and we can find a way to support them and finance them. And we're seeing that with our best clients.
But Vito, what's the risks in delaying?
The risk in delaying is that someone else takes advantage and you're sitting on the sideline left behind. And so we're seeing a lot of activity in some sectors where folks are feeling that, for example, if you look at the technology sector, I think folks are trying to build their pipelines from an AI perspective, and they're looking and saying, I need to be in here quickly. I can't wait to develop this on my own. I'm going to acquire it. If you think about some other sectors like industrials, they're looking to diversify their supply chains and think about making sure they've got ample supply in various geographies and so that they're tariff resistant. And they know they have to operate in this environment. We know it's going to not necessarily be what's out there in terms of a headline today, but we don't know what that's going to be. And I think they're planning for various scenarios.
Just finally, Lisa brought up the price of money. Do rate cuts make a difference? Do they move the dial?
I think, as I started before, I said we're looking for a signal for sort of people to make decisions. I think certainly rate cuts would be a good signal to the market and to buyers and sellers that this is an environment where we're ready to transact, and there's a level of confidence there. M&A is about aligning many different factors. And so you need your management teams, you need your boards, you need them all to have confidence in the forward outlook. If they feel that the Fed's giving a strong signal like that, I think that's a positive. But at the same time, I think the better companies are prepared to act in this environment. And so, again, I jokingly say we always have a pretty full pipeline. It's pretty full right now, but I'd love to see a lot of that transition to announced transactions.
You're certainly not alone. It's good to see you, sir. Thanks for dropping by.
Thank you for having me.
Vito Sperduto there of RBC Capital Markets.